They say cash is king, and there's a very good reason for that, and that is that cash is the lifeblood of any business, and it's a crucial part of making investment decisions. So let's take a look in this video at roughly what cash flow statements are all about. They're often hidden as far as investors are concerned. Most investors get as far as the profit and loss account, maybe the balance sheet, and then if they're lucky they get to the cash flow statement. But in a way, it's a pity that those bits of paper in a set of accounts are not presented back to front. Okay, so in this video we're going to do a beginner's guide to what cash flow statements are, roughly what they look like without chewing over all the detail, and ask some key questions about what they reveal as an investor. Now, this video assumes a little bit of knowledge, so if you find when I'm talking about balance sheets I'm going a bit quickly, take a look at my video, What is a Balance Sheet? And if you find that when I'm talking about profit I'm going a little bit too quickly for you, take a look at what is profit. And with that caveat, let's get on with cash flow statements. Right, what is a cash flow statement? Well, see it this way. You could say that a cash flow statement is like running a cine camera over a firm's activities for 12 months, whereas balance sheets are a snapshot of what the firm's worth. Okay? A profit and loss account is also a cine camera job. It records activity. So in this video, let's start off with what's the difference between a profit and loss account, which a lot of investors like to focus on, profits, a concept they like the sound of, and a cash flow statement, given that both are records of what the firm's been up to. Okay, well let's put that on a sort of map, if you like. So there's a 12-month accounting period. Most accountants work to 12-month periods. Okay, they can't cope with much more than that. So let's say the balance sheet is prepared 12 months apart as a summary statement of where the company is at that particular point in time. And that point in time might be something like the 31st of December. All right, so companies like to prepare their balance sheets every 12 months. And the balance sheet is a snapshot. This video is not about balance sheets, but a snapshot of what the business owns minus what it owes to give the net position. Okay, now linking those statements of net worth, you have a profit and loss account, and you also have the thing that investors often overlook, a CFS, a cash flow statement. All right, and investors tend to go straight for this. It's the first one they come across. It's a big page in the accounts, and they think, right, let's see what profit the company made. And it's not unreasonable to ask that question, but be very, very careful. Cash flow statements are at least as important, and they're often overlooked. Okay, so let's start off with what's this thing trying to show, and what's the link between the story told in the profit and loss account, this is trading activity, the story told in the cash flow statement, and these kind of snapshot camera summaries of where the business has got to every 12 months. All right, if you want to see it this way, P&Ls and cash flow statements are recordings, balance sheets are like pressing the shutter and taking a snapshot. Okay, so let's take 3 examples and see how a cash flow statement could be useful to an investor. Imagine at the start of the year you are owed 20 million by your customers. Okay, so you've got outstanding receivables of 20 million. Okay, you know the feeling, you lend a mate of yours some money in the pub, they then owe you that money and you hope to get it back. You don't necessarily record it in a ledger like an accountant would, but nonetheless it's money you are owed. So in a balance sheet that will be an asset of 20 million. And let's say during the next 12 months you bill your customers a further 70 million for work you've done. So that at the end of the 12-month period, you are now owed 80 million. Okay, so here's the story so far. You are owed 20 million at the start of this 12-month accounting period. Okay, you've done 70 million worth of work. Now that is what will appear in the profit and loss account, probably something like sales or income. You've billed your customers for work done. That's what profit and loss accounts are all about, trading activity. Okay, profit and loss accounts don't worry too much about the dirty business of actually collecting cash. It's all about what you've billed, what's gone out the door. It's all about targets hit. And you find at the end of 12 months, you're still owed 80 million by your customers. What does that tell you? Well, it tells you that you must have collected 10 million in cash. Okay, because that completes the story. Otherwise, how do you get from there to there? All right, so you start off being owed 20 million. All right, you bill 70. So if your customers don't pay you, all right, you're now owed 90 million. But actually, when you look up what your customers owe you at the end of the period is only 80. Wait a minute. We must have received some cash. Now, this is not, you'll be glad to know, an accounting course. All right, but the principle that I'm trying to get across is this. In the profit and loss account, billings of 70 million. In the cash flow statement, cash collected of just 10 million. And since that relates to the core operations of the company, when we build a cash flow statement, and we're not going to do a full one in a moment, we'll probably call that an operating cash flow. All right, and it's coming in. It's a cash inflow. All right, so there is a section on cash flow statements called operating cash flows, and just as you want profits to be positive, you want that to be positive too. All right, and when you look at a cash flow statement, if you see a big gap between what's been billed in the profit and loss account and what's been collected by way of cash, in other words, a big gap between a firm's operating profits or net income, all right, depending on which version of the cash flow statement you use, and the cash coming in, the cash inflow from operating activities, if there's a big gap there, that can be a warning sign straight away. Right, you need to know more. Why is there such a big gap? Okay, could it be we're being a bit slow on the uptake when it comes to billing our customers? And that could create a problem, because if they go bust before they've paid us, we're in trouble. Right? So, one example of how cash flow statements reveal a rather different picture, profit and loss accounts. Let's look at another one. Right? Firms don't just trade, they buy assets to use in their business. Okay? So, how about this idea? This is just really to show you the link and where cash flow statements fit into the picture. How about this as a story? Let's change the facts a little bit. Well, let's say at the start of the year, we buy a nice big juicy asset for 10 million. Okay, now, how do the accountants who put together profit and loss accounts deal with that? What they do is they ask the directors to sit down and say, right, you've bought an asset for 10 million. How long do you think that'll last? How long will you use that in your business? And let's say the directors say 10 years. Well, in the profit and loss account, believe it or not, that judgment, I think the asset will last 10 years, is booked against profits in the following 12 months. Okay? In other words, the profit and loss account is all about what assets have been used, okay, not necessarily what you've paid for. So, to cut a long story short, and I deal with that topic in more detail in another video, the profit and loss account will capture any depreciation, or amortization as the Americans call it, and we're going to say that's 1 million. That'll go in the profit and loss account. Okay? That means at the end of the 12-month period, in the balance sheet, you'll have an asset recorded at 9 million, the so-called net book value. That's the opening book value of 10, all right, minus any wearing out or usage called depreciation to give 9. But in the cash flow statement, there's none of this messing around, none of this, I think it will last 10 years, so let's book a £1 million charge. Oh no. In the cash flow statement, you paid 10 million, you book 10 million. All right, so in this year, I'm not going to wait for any more years to come by. In this year, the cash flow statement will show cash out of the full 10 million. There's another quite big difference. Because hang on a minute, you look at the profit and loss account, there's been this charge of 1 million. In the cash flow statement, there's a great wallop of 10 million. And that's going to produce quite a different net result in the two statements. These cash flow statements are pretty useful because you're getting a different picture as to what's going on in the business. And people who like cash flow statements would say you're getting a more reliable picture from the cash flow statement because you can't argue with cash flow. It's difficult to mess around with cash flow, less judgment involved. Okay? So, not surprisingly, in a cash flow statement, there's a section devoted to what are called investing cash flows, where companies buy and sell fixed assets, focusing on cash in, cash out. None of this messing around with depreciation and amortization. Okay? Let's do one third example and then see how this would all be pulled together in this kind of beginner's guide to cash flow statements. How about how about moving on through a company, because so companies trade and they buy assets they want to use in the business to generate more revenue and so on. What about a company that starts with £1 million of outstanding debt? Okay. By the end of the year, it has cleared it down to nothing. Okay. Now, if the company simply writes a cheque to clear a £1 million obligation or liability, the profit and loss account will show nothing. There is no trading effect there. You've just literally taken an obligation and cleared it away using cash. So, to cut a long story short, don't worry, this isn't an accounting course and doesn't need to be. To cut a long story short, the profit and loss account will show nothing. The cash flow statement will show the cash out required to clear that debt of 1 million. So again, if you pick up the profit and loss account, you'll see very little in relation to this transaction, all right? Because it doesn't add a profit or create a loss. Look at the cash flow statement, and you see a £1 million of cash going out to clear the debt, all right? So you can see there is a bit of a story in the cash flow statement about how the business is financed. So not surprisingly, the third and final heading, in case you're wondering how many there are, in the cash flow statement deals with financing activities. Right, so where have we got to so far? All I've done is give you 3 examples of how a cash flow statement might be put together. All right, we need a section that deals with operating cash flows. Those are the ones related to directly trading, day in, day out for a living. We need a section devoted to investing cash flows, buying and selling fixed assets, okay, long-term assets, buying and selling businesses. We need a section devoted to financing. That's, for example, issuing debt, which brings cash in, repaying debt, cash goes out, issuing shares, cash in, share buybacks, cash out, all from the company's perspective, don't forget. All right? So that's in fact what cash flow statements do. So without going into the full glorious detail of a whole cash flow statement, okay, I'm not sure how many people would still be watching if I did that with a pen and a whiteboard. What we can do is say when you pick up a cash flow statement as an investor, you can get straight in and look for 3 key headings. Right, you'll find in a cash flow statement there is a heading devoted to operating cash flows. There's a section devoted to investing cash flows, and there's a section devoted to financing cash flows. All right, and these could be positive or negative. You'll find there's subheadings underneath, but these are the big important ones in bold, and then you'll find there is a net cash flow, which is the result, positive or negative, of adding up these numbers. Now I've used X's, okay, so that could be positive or negative, that could be positive or negative, that could be positive or negative, to give a positive overall cash flow for the year, a story of whether cash has flowed into the business or flowed out of it. But let's take my numbers just now and do a quick compare and contrast. Now you might have forgotten what they were, okay, that doesn't matter because I'm about to write them up. But imagine you were looking at the story I just told in 3 transactions and putting together the cash flow numbers. Well, I said don't forget the original transaction, the trading transaction, we saw cash come in of 10 million. So on a very simple cash flow statement, 10 million of cash came in. That was an operating cash inflow, right? So it would belong up there. In my investing section, we decided that was spending 10 million on a new asset. So the cash flow captured there would be 10 million. And not surprisingly, I'm taking a bit of a shortcut here, there'd be a description under this big bold heading saying something like purchase of fixed assets. Okay, so it'd have a nice little subheading, but I'm just taking a shortcut to show the basic principles. And we said that we paid off £1 million of outstanding debt. So we presumably have £1 million going out in the financing section, described as something sensible like repayment of debt. If you look that up in a typical published cash flow statement, it'd be called something sensible like that. Okay, so actually, overall, 10 million in, 10 million out, that gives us a £1 million negative cash outflow, net cash outflow. So the business has chewed up cash over this 12-month period from 3 simple transactions. Okay, and for anyone thinking, Just remind me, what would that look like in profit and loss account terms? Why do I need to look at the cash flow statement? Why am I interested? Well, if you were doing a running sort of profit and loss account, all right, now we're not talking about profit and loss accounts in this video particularly, but if you were, don't forget from my first transaction I billed 70 million of sales. You might remember that. Okay, I can almost hear people frantically whirring back through the video, but I billed 70 million. That would appear in the profit and loss account of sales, transaction number 1. Okay, we decided that the asset I bought in the first year attracted a charge of just 1 million depreciation. All right, now profit and loss accounts are laid out slightly differently to cash flow statements, so all I'm doing here is getting to the net result, show how different it could be. And the third transaction we said had no profit and loss account effect because it was simply writing a check to pay back debt. There's no profit in that. You're just clearing an outstanding balance. Okay, so nil. So take a look at this. In profit and loss account terms, I'm showing a 69 million profit. Right, now you'd have to agree, even if you haven't entirely followed what I've just said, there is quite a difference between a piece of paper that says 69 million positive and a piece of paper a few pages behind it that says actually no, the true picture for the year is 1 million negative. Which is right? Right, they're both right, it's just their stories told from a different perspective. Okay, so how can an investor use all this? You're probably never going to build a cash flow statement in your life, so how can you use all this? Well, let's finish the video with a handful of key questions to ask yourself. If you were to pick up a cash flow statement, all right, so let's not worry about profit and loss accounts, except that we've just seen that there's a big difference in the net result. Picking up a cash flow statement, good questions to ask. Number 1, how different is the bottom line figure? All right, if it's very different, you need to start doing some investigation. Why is the business not making profits and chewing up cash? What's the story? Good place to start, up here. That's why it's heading number 1. Is the operating cash flow positive? Personally, if a business makes negative operating cash flows, i.e. it chews up cash, even just doing its day-to-day activities, let alone buying and selling assets or anything else, I'd steer clear. All right? And if there's a big difference between a firm's operating cash flow and its operating profits, I'd want to know more. That's not a trend that's sustainable. Okay? Number 2, investing cash flows. What is the business buying and why? You know, is this money going out to pay for whole companies? Is it money going out to pay for single assets? Are we replacing existing assets to survive, or are we expanding the business? So what are those cash flows? Okay. And by the way, for anyone who knows a little bit about accounting, one way of getting a quick snapshot on whether you're talking about subsistence fixed asset expenditure or expanding the business is to compare the depreciation charge in the profit and loss account with what's being spent on capex. Okay. For anyone who doesn't get that test, don't worry. All right, it's not vitally important to this video. Thirdly, investing cash flows. What's going on down here? Is the business issuing shares? Is it buying back shares? What's going on? If a business is raising long-term finance and it's popping up in this financing section of the cash flow statement, I want to know why. What you don't want to see, for example, is a mismatch. You don't want to see a business raising long-term sources of capital, new shares, long-term debt, simply to keep itself afloat, simply to fuel the loss-making activities that are gobbling up all of this money that's being raised. That's not good. You can't run a business on that basis. That's not sustainable. Short-term sources of finance go with short-term problems. Long-term sources of finance should be used here for new assets. Okay, not up here. Cash burn. Lots of internet companies have been guilty in the past of raising capital and just chewing it just to stay alive, if you like, not to invest long-term in their businesses. Okay, so take a look at all 3 headings. They are slightly different questions. Is the business chewing up cash in its day-to-day activities? Is it investing, and if so, where's it investing? Okay, replacement, new assets, and financing. All right, what sort of finance can you see coming in through the cash flow statement, and where's it going? All right, how's it being applied? And those are the kind of questions that you can answer from cash flow statements, but you'll get no clues on from just looking at a profit and loss account. So the message from this video is you don't need to be a cash flow statement expert. You don't need to get right into the nitty-gritty as an investor, but the 3 bold headings that hit you in the face from a cash flow statement are well worth a quick look. Okay, and if you want to test the story the directors want you to focus on in the profit and loss account, there's no better way of doing it than rummaging around in this document.